Happy Wednesday. This is Andrew Berman from National Mortgage Professional coming to you for the Mortgage Leadership Outlook. Thank you so much for joining us today. I am so excited to have OG blogger Julian Hebron, who's a top originator, a mortgage banking marketing executive, founder of the Basis Point. Julian, thank you so much for joining us today.
Andrew, man, it's great to be here. I'm super psyched to do this with you. We are way overdue.
Dude, so we totally are overdue. So listen, you and I actually first connected, like I want to say actually, when we were first starting up National Mortgage Professional magazine, and if I'm not mistaken, I think actually we might have connected on Twitter. I think that was one of our first things. And then I love stuff like this. This is you get Twitter. You totally get Twitter. Like stuff like this. I love this. This is great. So you see, actually, if you got to follow, if you're not following Julian on Twitter, you'll see actually it's business, economics, tips for originators, and then cool life hacks like this. I mean, how can you go wrong with stuff like this? Which, by the way, I as soon as I saw this, I sent that to my wife. I said, we got to try this. We really got to try this.
It is like literally what I said there pretty much encapsulates my sensibility and how I see the world and the whole thing, which is like, yep, I'm a full tilt yuppie like every other listener that you have and viewer. And, I'm doing my daily routines. But what I do get tired of sometimes is like people talking about just how much they're crushing. And it's also serious. So I do like to mix it up a little bit. But in all seriousness, I was like, I don't think I want to find another way to deal with these almonds. So I'm throwing them in the coffee grinder because I'm in a hurry. And it was awesome. I did it again today. That was yesterday. I did it again today. It was great.
That's awesome. That's awesome. So listen, if today, actually, Julian, some of the things I want to cover, I want to actually understand, what was your reason for starting the Basis Point? I mean, when you started the Basis Point, you were cranking it, top originator. We're going to talk about the UWM, rocket, whole debacle. Talk about that, some concerns we have. We're going to dig into the future, what you see happening from capital markets perspective, opportunities for originators. And first thing, I before we even get started, most originators are on Facebook, so because they're tracking actually what real estate agents are doing. They want to know actually life events for their borrowers. Mortgage executives, most of them, generally speaking, are on LinkedIn. They want to know what's going on with LinkedIn. You are on Twitter. Twitter is actually you've not only actually embraced, but you've mastered Twitter. So what is it about Twitter that you love?
Well, first I'll come back to your previous point, which is the originator listeners and viewers are totally spot on. And I often think it's a weakness of mine that for some reason, personally, I don't have as much of a, Facebook doesn't grab me in the same way that Twitter does. And it's just for some reason. Now, from a purely pragmatic business standpoint, we all know that the biggest audiences are on Facebook and Instagram. From a consumer standpoint, and that's where a lot of business is being done. You just hit it spot on, but I do quite like Twitter just because it's, to me, it's like this river that it's just always, they've kept very true, at least so far, to the not so tailoring the algo to only what you want to see, but it's this river of stuff that's flowing by all the time, and you can sort of pluck stuff that you need. And then there is a distinct voice thing, and it is harder to start on there. So from a business standpoint for the originator crowd here, it's not that useful, frankly. For me personally, I just liked it. And I do tend to I'm a pragmatist. I like making money. But I do tend to try to let certain things pull me in a direction, for things that I really like to do. And for some reason, I don't know, I can't put my finger on it, but even with all the toxicity that we have during election cycles and stuff, I still like it. Now, to the question of the Basis Point itself, I mean, this goes back, you and I have been collaborating and talking for so long. And so long story short is this: as an originator, I was like an OG newsletter guy too. Now newsletters are like this thing. And back then I wrote a Friday newsletter. It was called Market Week. And then when August 07 hit and everything went to hell, I started expanding it from a 2-paragraph newsletter that was really for clients and realtors on Fridays, and the realtors would get it. They knew how to talk rates at open houses on the weekends, all that stuff. And this was religious for years. And I basically got all my realtor business from it, right? In that fall of 07, I bought the domain for the basis point a couple days before Thanksgiving in 2007, launched the site in January 08. And it was really always about like serving as the marketing machine for my book, right? And then it became the marketing machine for running teams. And then, I worked with a previous company to build it into a marketing machine that powered a lot of that whole company's marketing. And so it kind of just, it evolved in that way. And then it evolved one note past that, which was when I was working for a big bank, I had to put it on life support. They didn't want me to be running that publicly. Yeah. So, that phase passed, and then some consulting work started coming up where, one of the big ones was Zillow, and they had come to me and they were getting their mortgage operations stood up, and they wanted some help from the basis point on a few things. And so we worked with them for a couple of years while I was also doing mortgage banking stuff. And that's when I was like, wait a second, there's a whole business here. And to me, it's always been two. There's like a media business and then a consultancy. And the core business day to day, like I said before, in terms of like being a pragmatist around income, and where I think we have the most impact is on the consultancy. So we spend a lot of time on that, and it helps me make it. We do less content than we used to, but we can still do whatever we want, and we don't have to be. This is the first time in my career where I can actually be outspoken about certain issues that I have some fire behind, and I'm not in some way skewed by being inside of a financial institution, right? So it's been an interesting journey to learn how to do that responsibly. And I know our next topic is like the perfect way to frame that.
What setup, Julian? It's great. Yeah. I think you can't actually, there's no other question that we can answer besides actually going into what is the impact of, it's called an attack, like, the UWM attack against Fairway and Rocket. Could it, do you see, I want to know, what do you feel about that personally? Like, what did that make Julian, the entrepreneur, the originator, what did that make you feel? And I also want to know if you feel actually that this is going to lead to a price war and a subsequent, margin compression.
Well, so I'm a long gamer. Anyone who knows me knows that, that. Most of the folks that know me that are watching this know that. And cycles are so important. And our industry has always fascinated me because I came in from the money management business, whereas this very, I was taught early, like it's full market cycles or nothing. And yet our industry obviously survives and thrives through full market cycles, but the production mindset is definitely more of like of a monthly, quarterly behavior, right? And so it's like this. I have been asking for years, senior execs, who's the customer? Is it the end consumer or is it the loan officer? And I want every originator to listen to this one very carefully that's watching this issue. Everyone knows that most execs say the loan officer, right? Because the loan officer is their viability, it's their market share. That's how it works, because most of the market share is still predominantly retail rather than direct, right? And retail, we can include broker in retail, because it's consumer-facing loan officers generating the business. So all execs are going to say the loan officer is a customer. I have had a line in the sand on that since long before AIM or Brawl or anything else, which is the customer is the customer. And I formed that sensibility as an originator. Okay. Boots on the ground, belly to belly with people, signing papers the old-fashioned way, like The loan officer has all the leverage, right? And so I've been really surprised to see certain loan officers sort of saying, yeah, like, and I feel like some of the sentiment around, let's say, brawl as an argument versus just full market cycle long game as an originator who wants the most amount of options all the time. That's the professional originator loan officer's mentality. I need all options all the time. And I'm going to go where I'm going to get those options. And so for me, a decision like this is really complicated because I can see where today I'm siding with this line that's been drawn in the sand by a top wholesaler, and it's because I need that product. But if you game that out over the long haul, you and I both know that the deck, if you will, on the leading wholesalers completely shuffled from what it was in the last cycle, and it will be shuffled again in the next cycle. So for me, to all of you originators, please think carefully about what this means for you. And I get that if people are like, well, what it means for me is I'm going to go with the one that I'm familiar with now that has, a third of the market share in broker, et cetera. I get that. But all I'm saying is that I just think there's certain precedents there that remove the core value prop of I have access to all options all the time, and I can look my clients in the eye and say that.
So
that's a long answer, but as you can tell, I do have some passion around that one. It's a big deal.
It's and the funny, you can't even say that you have all options, because you either have to have one option or if you're cutting actually your options off either way you go. So if you are a mortgage broker today, your decision would be, I want to be able to have my options open, and I'm going to actually choose to do business with whoever I want to do business with.
I'll be plain. I wouldn't sign that addendum because I would, if I'm a broker today, I'm not signing that addendum because I believe that it even though, because I've been told if I don't sign it, I lose that option. Mm-hmm. That's not, I would still make the decision that that keeps everything else open.
Yeah.
And it's an incredibly difficult decision. There's no question about it, because when the market leader tells you be loyal or piss off, I don't know if that I fully get how hard that is. We've all had to make product decisions over time, in terms of how am I going to make sure I have access to the right product for my customer base? But in terms of that core broker ethos, with my loan officer hat on, I still want to be able to look the clients in the eye and be like, brokers are better, and we're better because we have access to all the stuff. Now, if we're pawns in a game that some bigger players are playing, that's part of it too. But at least looking those customers in the eye, I'll speak for myself. I would know that I'm making a decision that's like, hey, I made a decision that keeps to that promise of I have access to all options, because that's why I'm independent. The thing I love about we know this for full cycles, it's always oh, the broker is going to finally go away. And it's just not true. Brokers are maybe the most resilient, and they're always, they're the smart ones, because they're well, I can be independent, and they do get that they have all the leverage. And that's my biggest thing. You have all the leverage. So if you have to make decisions that make you part ways with either, a certain set of product over here or a certain set of product over there, no question, that's a nearly impossible decision. But I know how I would decide with my loan officer hat on, and it would go to the core ethos of what I believe in long term.
By the way, do you miss that hat, that loan officer hat?
Always. I talk to all my former team members all the time, daily. And we still talk deals. I still have clients call. I'm working on one today where somebody said that they've got 17 homes and they need to deal with them somehow. And this is so this is where I call my former team members. I'm like, hey, what can you do? I need to know who, this is a complicated one. I need to know who to pair it with. And I do this stuff like daily, actually. But here's what's interesting. And all your listeners will be like, this guy's crazy. But like, I don't take any referral fees or anything like that, because again, going to what I said before, this new journey, I'll be 3 years this summer full-time as the basis point and not as a banker or a lender. Yeah. And I think it's really important. It's been really important to not make so many little side deals that like all my thinking is compromised. I like to just be able to be like, yep, I can still have clients call. I can have anyone reach out. The basis point is frankly like a lead gen machine that I've never turned on, but there's leads that come in for that, and I just give them away because I just don't, I haven't figured out what I want to do yet, but integrity above all else. So like the less money you take, the more options you have to make your own decisions, and you're not compromised by money you're taking.
Yep. That makes sense. So, but do you think actually do you think actually we're headed like straight towards another margin compression, and one that could just be as ugly as possible?
I don't know if as ugly as possible, but certainly, we already know now we're going to get a lot more visibility than we ever got. Not we, but the rest of the world is going to get a lot more visibility than it ever got in terms of understanding gain on sale and what it means, how important is servicing in a full market cycle. And I think we're going to see that it's going to be incredibly important because Wall Street, just like in the last cycle, doesn't fully understand that this is a little bit more resilient than people think. We know that mortgage is this wonderful cash flow business, but it's never been this valuation business. So I'm going to answer this dimensionally. Going just straight to our normal concerns day to day on margin compression, and then also the broader implications of having more public companies. And then meanwhile, concurrently, you have more fintechs maturing into full banks. And what does that mean as mortgage and mortgage companies and fintech companies maybe start to come together? But just sticking with the basics, of course, Rocket is the best example of the biggest institution with the most originations and the most servicing. And frankly, their valuation is quite flat, right? I believe that when the street watches us move as we move through 21 Q1, the quarterly figures for originations, gross purchase and refi originations is the same. We're going to do 700 billion plus in a quarter, just like we have in the last few quarters. But then it's going to start to drop off. And then who captures the most purchase business obviously is going to be a factor. And then how well does servicing support valuations? That's what the public world is now going to be looking at, because we have a lens on us like we haven't had in 14, 15 years, because there just weren't any public mortgage companies, mortgage only, right? I think that because of the cyclicality and because margin compression is going to be real and all these things that happen, because what is margin compression is like a fancy way of saying, to your point, like we're going to have a price war, because that's what always happens, right? Like there's less business and we got to lean into it more. And thankfully, margins have been very, very attractive for a long time. And one big reason, ironically enough, was frankly to control capacity. That's why we're squeezing an extra quarter out of this, because there's a bunch of excess capacity. But on the servicing side, the smart servicing money knows that. So once that margin comes out, servicing values really come up quite a bit. And anyone with a great servicing book is going to do great, right? And that's where hopefully these public valuations will prove that the leaders out there that have gone public, like hopefully as long as their servicing books validate that for the street, those could look like good plays. But I still think, just knowing what I know about mortgage company finances, it's still a cash flow, not a valuation business. You're never going to get like a fintech valuation on most of the public mortgage companies. So one really cool thing I think is going to happen is that you also concurrently have the fintechs that are maturing, that none of them have mortgage in any meaningful way. And they're going to look at mortgage and be like, oh my gosh, this is incredibly difficult. So I'll give an example, if I may. I know I'm going on, but if this is interesting to you and your audience, like the SoFi announcement of buying California Community Bank yesterday goes straight to this. So should we talk about that for a second?
Please, yeah, that'd be great.
Okay. So SoFi is, I'm in San Francisco, and they made a very, very strong push in mortgage, right? For not since day one, but pretty close. They were founded in 2011, and really around 14-ish is when they 15 is when they launched mortgage, right?
Yeah.
And it just never became like this overwhelmingly dominant product. We know that Stearns came to power it eventually. But the building of mortgage, we all know, you, me, and everyone who's on here with us today knows that mortgage is just a little bit harder than it looks. And everyone always likes to talk about how simple it is. It's the most complex, period. And the fintech community knows this, but they do have sexier valuations. They've raised a ton of money. They're really super strong on capital raising. And I think as they look to diversify their lifetime customer engagement propositions, they're all going to look at these relatively cheap public mortgage companies and be like, let's go get them. Or there's a bunch of PE-owned companies that still need exits. Like there's going to be some really clever, cool deal making, which I think goes to like future of LO and where the LO sits in all of this too, you know?
Interesting. So you see actually that there's going to be a lot more acquisitions. Like the fintech companies are going to look at, these relatively undervalued, mortgage companies that are now public, and they're going to look at actually their P&Ls and say, wow, we could trim here. There's no reason actually that they need to be paying for this, and see actually those opportunities. And I'm just like, I know actually I wanted to cover this. I mean, so where does the originator fit into these new models? Do you see actually, in a fintech coming along and buying actually a traditional mortgage company? Should those originators be worried?
I think that a couple things. One, the first AI in mortgage was in 1994. We're 26 years into it. Okay. So all the talk of innovation and everything else, 94 was like the clues, and then a year later was DU. Okay. Yeah. So we're talking about like, the narratives are louder now because of social and everybody has a voice, but the fundamentals are proven over a few decades. Of course, it will continue to innovate. And yes, we will move more toward direct, but I have changed my view on this. And again, getting a more sober view as not being a banker anymore, but being more deeply tied into the ecosystem than I ever have been. I'm like, here's the thing. Again, going back to the SoFi example, SoFi buys a community bank. They buy it to kind of help advance their sort of banking charter agenda, also to grab some customers. And, but it's more for the former in that case. But when bigger, more sophisticated, like digital native challenger banks start doing stuff like this, it's always going to be about acquiring customers or acquiring products, right? And so also the public lens that all firms will now have on mortgage industry economics for real. And we just said before, we know that most of the market share is in retail. There is a convergence. This digital native stuff is kind of like the phases of a startup of like, we're going to reinvent this and we're going to change it and we're going to digitize the whole thing. And then all of a sudden you're like, oh wait, financial services needs humans. It's just that simple, right? So with that said, great humans that are paid, 12 to 50 basis points in a direct shop are still never going to gain in aggregate quite as much market share as saying we can be very profitable and we can run a retail sales force, and we can have a cool, slick digital first brand, right? So like there is this convergence of like the great mortgage companies that are retail only, that are like fintech powered under the hood, but it's all retail LOs. And the same thing's going on in the digital banking community. So we're having a convergence, and the matrix is just being built again with fancier language around innovation. That's my take, is like, I think that humans stay, but you still have to be smart. You have to pick which horse you want to ride and what model and all that. Maybe commissions go lower, but I mean, we're not even close to that now. The ones that want to make 150 bips make 150 bips, you know?
Yeah. And you know, something, and it also, it might be commissions go lower, but you're doing more volume because you're dealing with less minutia as an originator, and you're just focusing on, you know, the highest value that you can do, which is, you know, working and talking with the borrowers, making them feel good about actually their decisions, understanding their needs, and then setting up new funnels, like, you know, new funnels of activity, whether it's real estate agents, you know, referral partners, you know, the community involvement.
From day one of my originations career, because again, I came in from the money management business, so I kind of went after financial advisors before I ever went after realtors, right? It's just sort of more in tune with how I was doing things. But also I'm in San Francisco, high price market, competing against a portfolio institution since long before the crisis. And as such, like, we always worked for 70 bips anyway. So it was always like, well, we better get a bunch of volume, like, you know? And so, and the independence was the same thing. I need independence. I need to be able to market the way I want to market, right? Because from day one, like with those newsletters that evolved into the basis point, and then, you know, I gotta have product. For me, that was always a tricky balance. I eventually took the whole group over to a big bank because we're like, after the crisis, like, you really needed a portfolio. The non-banks just could not compete on jumbo, you know? And so for me, that's what it is. It's like independence and product and price, and how much do you make, right? Those are, though, it's that balance of factors will go on for another 15 years. Like, people will still be able to make their money and serve their customers, but those are the four balances, you know, and people will have to make choices of like, okay, I'll make a little less, but I'm going to keep my independence, or I'm going to go over here where I can make a bunch of money, but I got to do everything exactly how this org wants me to do it and all that kind of stuff, you know. I think it evolves.
So I wonder if like how do you have like the best of both worlds for like independent originators? Like what can independent originators learn from big brands, and like, how can they model their messaging and their future practice based on what we see big brands doing? I mean, you've had an involvement in some major brands, obviously, Zillow, you know, Loan Depot. So would love to get, you know, your guidance on what our independent originators can do, you know, that they could learn from big brands.
One, I came up in a big bank, so when I exited that and entered the mortgage industry, I entered because I hit it off chemistry wise with a CEO who ultimately, in all told, put in 13 years with. But it's this, like, we're big enough to get most of what we need at all times from a product and a price standpoint, but we're independent. We can do things the way we want to do them, right? During that time, I have a great case study where I had recruited somebody as a second assistant, and then this person was like nails, and then ultimately went to become a top producer, both in that organ and then we went to a big bank. Okay. And then that person, when we got to the big bank, was like, WTF, right? Like, I can't do this. And I'm just like, I know how to do this. Just let me get everyone out of your way. And so this person became a super heavy hitter inside of a big bank, and just recently is now going back to a non-bank. So to me, that's the quintessential case study of a LO groomed in the non-bank environment, first a broker, then non-bank, then big bank, and then now back to non-bank, because eventually it's like, and so here's the answer to your question. The choice is, in that example, for this person, I became big enough to where I'm kind of the brand if I'm working for an org that has the right product and the price for me and allows me to have enough independence to kind of run my marketing and my world-facing stuff my way and not their way, right? So the ultra big brands will always be like, you know, as another former colleague in the big bank world said, like, you know, we're the stagecoach, we're not us, you know? And so that's one way of viewing it. But the other way is, I think that in this cycle, especially the big non-banks right now, this is broker stuff aside. This I'm not talking wholesalers. I'm talking like correspondents that with their retail divisions, but like, they're super sophisticated and they fully get it. It goes back to that question of who's the customer. The LO is the customer. Let them run their own brand, and they get it all day, right? Yep. And so as long as they have the product and the price for the consumer and the comp, it is always going to be a balance of those things. I did a session with Marina Walsh from MBA. She's their head of research for something else that we did recently, and she was talking about what this means from a comp standpoint, and it's like what the quote unquote elephant in the room is LO comp in terms of being able to switch from a retail to a more direct type of industry. Mm-hmm. I don't even know that it's necessary, because the spend in basis points that you would have as a direct firm versus a really sophisticated retail firm, you're going to spend a little bit less in basis points as a direct firm, but your marketing spend is material, right? Those companies are harder to start. They're way more capital intensive, and running a great retail operation is economically sound, and everybody can win. The companies can win. And most importantly, the sales forces, the loan officers can win, you know?
What size do you need for that to run a direct retail? Where does it start making sense? Like what numbers do you need to produce? You're going to be a direct retail mortgage lender. Is it 20 million a month? Is it 100 million a month? Like where is actually the point actually where where the ownership actually can start saying, all right, we are doing good and we're cruising well?
I'm not going to give you maybe an answer that's like the catch-all here, because one thing that I have learned observing how some of the newer shops get started over time is either A, certain people that were in retail, but they created their own brands and they're like, we're really effing good at this, and we know how to generate our own business, and we know how to do social, and we're just going to create our own machine. There's that. They just don't need to be that big. Their whole play is independence, and they do very, very well, and they're not trying to like take big swaths of market share. They're just trying to get theirs. And then there's a step up from that, which is there's all kinds of like lights out customer acquisition scientists out there that have worked for some of these big shops, and they go and they start their own things. And that is where you start to say it's a lot like retail. Like at some point, you've got to cross over like it's like you got the $2 to $5 billion mark, and then it's a pretty big jump to go from 5 to 10, and then going above 10 is like incredibly difficult. I'm talking about annual volume, but that's where, there's plenty of shops that can be below 2 billion that do great, and those teams kill, That's one great thing about our industry. But if you're talking about like material market share, household name brands, or moving the needle towards that, that you have to go above 10, right? And there's a world of difference, but like getting to 5 is hard, 5 to 10 is very hard, and then going above 10 is like it's you're running a totally different model, like and that's where you do need to start spending high 8, if not 9 figures a year on customer acquisition and all that kind of stuff.
Yeah. So the small under 2 billion a year producers, like they're here to stay. Like it's still like it's a good place to be in the business. I get worried. I just get worried that as we potentially see, a margin compression, that those guys are going to have some difficulty, and I worry about that. Like I remember actually, our last margin compression, how they're like the producers that were just, they were doing under 2 billion a year. They felt it. And they were the ones actually who almost got shaken out of the business. At least that's what it seemed at the time.
And this is where in direct, it's that much more acute. Like you basically have to raise money. You have to take on, you have to do VC or take on a PE partner, whatever, if you're doing direct. But I do think you can be a little bit, you're either really small, like we were saying, like certain folks that are like, hey, look, we're like super producers. We're not trying to build like a juggernaut organization, right? Yeah. And there's always room for that. But if you're trying to build an org, you could argue that it's more viable retail versus direct because your spend is not as great because LOs are 100% commission. And most importantly, like you can buy, you can build a direct business in a refi market, but like the lead business, when it comes to purchase, as we know, those are long lead. The conversion is way lower and it's super hard. Whereas you get X number of great producers and you're building it the retail way, you can be quite viable.
Yeah.
And you've got some of the big tech orgs. I mean, you've got both ICE and BK going to war with each other for the middle market, which you would have thought that BK would not do that, but there's plenty of technological infrastructure that can be stood up fast for small players, is my point, right? So yeah, you can get off and running. And it will be interesting though, to see, to your point, how many do, or if they're like, going to hold, and see how things shake out.
Yeah. I just wonder if we, in a couple of years, and all we see is basically big giant mortgage companies and really, really small companies, and to cross, actually, to get to that next level, it will be very difficult. But so listen, I want to wrap up here with getting your perspective from a capital markets outlook. I want to actually, you've between the basis point, between your insights that you share on Twitter, and just interviews that I've seen you do actually, with guys like Dave Savage. I would love to actually get your perspective. What do we have to look forward to? What should we be worried about? What should our eyes be paying attention to?
Well, and forgive me if I look away from the screen just for a sec, because I'm just looking. Okay, so we're at like 152 on the 10-year note today, right? And if we break down, consensus projections quarterly for the 10-year and for the 30-year mortgage, right? At least as of now, a lot of the estimates are kind of calling for, like, of course, the far end of the 10-year is like, it's going to be 2 sooner than you think. I think it's possible. But we started the year mostly with like, it'll probably, hold it around 1.5 for a while. Everyone knows, like, we had the big rate spike just happened. And it seems to be, for now, leveling, right? And this is what happens when we move into a different realm. So fine, we gave up a 0.5 point in rate, right? And so now what's happening is in a 3-week period, and that's super jarring. I still, like always, I have my screen up every day. I watch this all in real time, all day, every day. And I still feel just like I did when I had a whole pipeline to lock and deal with. But with that said, we had our 0.5 point rate spike. Okay. That brought us to a level that coincides with what the 30-year was supposed to be. The 30-year rates were supposed to be like 2Q, 3Q, and potentially even 4Q. And we might, as we have done in previous cycles, have just gotten there quickly. The bond market's very smart, knows what to do. and it is always going to trade ahead of any inflation fears. But a lot of this goes to that. Okay. So the stimulus just passed. And there's this, in fact, I just put a post up today on like, is the inflation fear real? And my take for now is no. I think that just like I had a little scare in 08, post 08, excuse me, of like, are we going to move into inflation with all this stimulus? And I've kind of changed my tune on that. I thought that for a while. I watched that market cycle play out, and I'm definitely in the camp that believes that we're going to have some short-term volatility without question. But I do think that knowing the hardship side of this economy and how far we still have to go, volatility aside, we should balance out, and we probably do still end up at, somewhere between 3.5 and 4 as we close out this year on the 30-year. We can come back and see. You can call me out on that later, but in other words, like there's another half, like 3/4 ish that we could go. But even then, like the fact that we're talking about a rate spike taking us as high as 3.75, say, I mean, come on. If you look at the housing projections, all the housing sale projections for the next few years have all this baked in. This is what's so important. All the housing sale and units financed projections bake all this stuff, bake the higher rates in. And if we do that, this industry will do 5 million purchase units this year and next year, right? So I think that's really important. Like everyone can like stare at rates all they want all day, but it's like, just know this, like this year, you'll do 4 million, the industry, all of us together, 4 million refis, 5 million purchases, units. Next year, 5 million purchases and like 1.6 million refis. So with all of that said, that's all anyone should care about. Like yep. I got 5 million purchases this year and next year, and that's my business model. And the rest is chatter. That's how I would answer that question.
That's great. And listen, I mean, and I think actually the independent originators, that's where we hit it out of the park, from an experience standpoint. I mean, this is like, it's just doing a rate and term refi just is not sexy. It's not exciting as helping someone move up, helping actually someone, get that first time purchase, which then all of a sudden rate matters a lot less. And it's just about
it does. And what matters is it's a different muscle, no question, because it is a numbers game, but it's a realtor's numbers game. And I got to issue pre-approvals for every deal, make sure that property is clean, and that if they get into contract, that yes, of course I vetted them when I pre-approved them, but I'm vetting every property before those offers go out so that I know if that one gets into contract, I can bang it in 20, do the next one. And that realtor is going to send me 4 more, like that's the game. And it is a different game, no question, than the refi game, but everyone who's great at purchase knows that that's the game, and you can just crush those all day. And you get 2 realtors on every deal.
Yep. Yeah, listen, refi game in 2020 was just being good at answering your phone.
It's well said.
Yeah, I mean, and that's why we saw actually so many people just flood into our industry.
Yeah,
it's unbelievable how many actually people I'm seeing actually on boards, on the Facebook boards, where basically saying, "Hey, I just got into the business. What do I do now?"
Yeah, well, that's my recommendation. Is like, realtors love attention, and they love closed deals, and they love getting paid, and they tell all their friends, and the listing agent, that's the secret of all of it. Like our model used to be, you're really good, not if the buyer's agent that you work with who sent you the borrower in the first place is happy. It's when the listing agent's like, holy shit, like, wow. And then they give you their business too. That's when you know that you're in fighting form on purchase.
Yep. Fantastic. Julian, great hanging with you.
Totally, man.
we covered a lot here. Really, we covered, of course, why actually you started the Basis Point. Covered a little bit about your career. Covered actually, the UWM, kind of going after Rocket and Fairway. Talked about capital markets. Got some outlook for what originators should be looking at for the future. Great hanging with you. I really, really appreciate it.
Likewise, man. I'm glad to be here. Glad to be able to, connect with the community. You've been super consistent about serving your community with your platforms, and I love it. I follow it every month and every week.
Fantastic. And please also make sure you follow Julian.
Thank you.
Get on there and do this. This is such a good idea. I'm going to be doing it too. Very cool. All right. Thank you for joining us for another Mortgage Leadership Outlook. We come to you live at Wednesday, 1 o'clock Pacific time, 4 o'clock East Coast time. Got exciting actually guests lined up for you for the next couple of weeks. So have a great March, and we will see you next week.